Good afternoon, everyone. It's Bill and Wendy with Carolina Capital Management. Welcome to our Passive Income Active Wealth Show. Don't forget to like, share, ring the bell,
Subscribe,
hit the
tell all your
bell,
friends,
subscribe.
gossip, whatever it takes.
We are a lender in the Southeast. We do short-term hard money loans. If you're a borrower looking to borrow money, go to our website, carolinahardmoney.com, and you can click on the apply now button. If you're an investor looking for passive income or long-term growth passively, then click on the investor tab.
You are so full of excitement. It's just bursting out of you.
Oh, come on. I'm using my FM voice.
Oh, we need to be excited. Christmas is coming, so I'm ready. I've got my holiday shirt on. I'm ready to go. He was making fun of me earlier.
It's coming too soon.
It is.
It's not even Thanksgiving yet.
I know, but
Stop it.
I was going to wear this.
We've had Black Friday sales for the entire month.
That's a long Friday, isn't it?
Yes, it is.
Well, we're all miscombobulated anyway. We've had the plague, and now we're pretty much over it.
Yeah.
And back in the swing of things. I'm really
I'm back to my
thrilled.
Regular whiny self instead of my sick whiny self. Excuse me.
And Jonathan is stuck in traffic, right?
Yeah. If you're not around this area, we've had a lot of rain.
Serious flash floods everywhere.
We got alerts on our phones about life-threatening flash floods, and poor Jonathan is on the other side of town trying to get across here, and he has to go through water and accidents.
That's right.
Hopefully he won't have to be rescued.
Well, he's in a truck, so that should help a little bit. A very little bit, but yeah, it's kind of spooky. There's a lot of floods going on, and some of our good friends that are our virtual assistants are dealing with typhoons. 4 of them
in the Philippines.
In what, a month? They've had 4 of them.
16 days.
Yeah. So that's
so pray for those folks. Yeah. Got a lot of fast moving rising water there.
It's crazy.
Yeah. Climate change.
That's what it is.
Why are you laughing at me?
Because you're such in a fog today. It's unusual for you.
Yeah. I went back to my boot camp classes this week, and I only made it halfway through the one on Monday.
But you made it. That's awesome.
And I made it completely through the one last night, and I'm a little discombobulated.
Yeah, you got to get slowly back into life.
Baby steps.
That's right.
Okay, that said, let's talk about the breaking news.
Do you have any updated breaking news?
Yes, I do. And perhaps... And as I finish that, perhaps our professional graphics will pop in.
That's right.
Thank you, Scott.
Yeah, and Scott's
he's not feeling well either.
But it has nothing to do with the plague. I think he says he might have eaten something a little off.
Yeah, he had some
in Cancun. Poor guy. He's got a rough life.
Yeah, he had some bad rabbit food.
That's right.
For breakfast.
That's right.
So. New unemployment numbers, they expected to have 735 new unemployment. Turned out it was 709.
So even better. Good.
It beat expectations.
Yeah.
And then our continuing jobless claims went from, and it was 6,900,000 last time, and it's moved down to 6,780 something.
Well, that's good. That's lower too.
Yeah.
Excellent. Excellent.
The economy is chugging along. The things that you have to worry about right now is you've got certain states that are starting to lock things down again.
Yeah.
And
I think North Carolina is one of them. Right?
And I'm sorry, I'm going to have to get on the soapbox.
Get up there, Bill.
All I keep hearing about is we're going to follow the science. We're going to follow the science. what science tells you that anything spreads more after 10 o'clock at night than before 10 o'clock at night?
I like that one.
I got to close my restaurant at 10 or my bar at 10 or my gym at 10 because the disease is more infectious after 10 o'clock at night.
Or how about the limited number of people that you can have in your home for Thanksgiving versus the amount that you can get together with on a funeral, or even the voting polls. Let's talk about that. It was okay with people with symptoms to wear a mask and gloves.
It's one thing
to go vote.
It's one thing to say we suggest or we would appreciate if you didn't gather more than this many people in your home during the holidays to help keep the spread down. It's another thing to say that I'm going to have the police enforce no more than 10 people in your house.
Yeah, well, I've heard most people say they're not going to enforce it, but what I think
the
is
governor
really...
actually said he wants to...
Of North Carolina?
No, the governor of New York.
Well, they're crazy anyway.
Said that he was going to have the police enforce this.
Yeah, that's kind of insane. That's really
what a waste of time. How about really enforce the laws for the actual criminals?
Yeah. So I also heard that the survival rate for COVID is like 99 point something percent to begin with. And that's pretty incredible. I heard that this morning.
We are having more cases, but I think this thing is kind of blunting itself.
Well,
and at the same time, they've got treatments and they understand it better.
Mm-hmm.
We still have to protect our vulnerable. Don't get me wrong. This is a killer for people that have underlying conditions.
Yeah, we lost a cousin to it. It's heartbreaking.
At the same time, you can't just shut everything down. It's not going to work. People aren't going to take it anymore. They're already stir crazy. You're not going to make them go through this again. It's just ridiculous. Just make sure you wash your hands on a regular basis. Wear a mask when you're around folks.
Don't touch what your brother touches. I have to blame you.
Yeah, of course you do.
Of course.
Now I forgot what I was going to say about more of the economy. Oh, housing market is really a bright spot.
Yes, it is.
And it's going to continue to be a bright spot. Interest rates are going to remain low, especially if they keep shutting down parts of the economy.
Yeah.
That said, people if they're going to be stuck in their homes, they're going to want a better home.
Mm-hmm.
So anything that has to do with housing, new construction, rehabs, existing homes, people are buying stuff from Lowe's and Home Depot. They're buying furniture. They're extending their living areas into the backyard. Mm-hmm. So you're gonna see a lot of.
So the outdoor companies will do well.
Yeah, and maybe even those folks that can do those 3-season rooms,
right?
Sunrooms, that type of thing. If you're going to be stuck there, you're going to want to be more comfortable.
Absolutely.
And if you're going to vacation at home, maybe even the pool companies are going to start picking up. Mm-hmm. So anything having to do with the housing market is going to be a pretty good bet for quite some time.
Yeah, I agree. And I'm amazed too at the number of people that are moving out of certain states into the Southeast. I have several houses that we're doing a few fix and flip on, and I'm amazed at the people that are looking at the houses that have put their homes on the market. One's coming from Washington, D.C., another one, New Jersey, and another one from New York. And they've put their houses on the market. They have cash to buy our houses. Now, these houses are selling in the 100 range to 150 range, sure. But I'm just amazed at the amount of people that are coming down for the same reason, because they're not happy with the way their states are treating things. So,
well, I've been keeping my eye on Southwest Florida. I like that area.
Yeah, he's looking. So anybody that can.
But what I've noticed over the past few months is that the good deals that were there before are not there any longer.
Mm-hmm.
And if there is a good deal that pops up, they're getting multiple offers, and it's end up raising the sales price, because you can follow this. If a house goes under contract and then sells, you can see how much it sold for versus what they were asking for when it went under contract.
And
And now
that's happening everywhere.
yeah,
really.
now those prices are starting to move up, or the actual closed price is moving up.
Yeah.
And they're doing this because they're low tax areas.
That's
Florida
right.
doesn't have an income tax.
That's right.
And they're fleeing these areas that are shutting down and taxing the crap out of you.
But if you are in real estate in these markets that are really, really doing well, and there's several of them, don't go crazy thinking that, oh, the values are going to all expand and, I can go into any price point and do this. And you still need to be cautious with what you're doing. Be smart. Stay within your formulas. Don't do anything you wouldn't normally do, because we just don't know what's going to happen. There are so many variables going on in the market with, and we can't even hop on the election. That's a whole nother thing. That's just an unknown at this point, how things are going to go, what's the cabinet going to look, all the different things that are happening there. So we need to be smart about what we're doing.
That said, if you're a stock market person, some of the stocks that you might want to think about are, Home Depot, Wayfair. Another good one is D.R. Horton. D.R. Horton is a builder of affordable homes, and that's always going to be a sweet spot. If you're buying stocks, to me, you buy the ones that, and again, it depends on, everybody's different in their investing. I'm looking at dividend paying stocks that aren't utilities, because they're never going to grow. They're going to pay dividends, and it's, it's pretty steady, but it's still better than buying bonds.
Right.
But Chevron, for example, they're an energy stock that is a petroleum company. And why would you say buy Chevron when oil is at $41 a barrel?
Yeah.
Well, they're paying a 7% dividend. That's important. That's a pretty good return, and they've been paying dividends for 138 years.
Yeah, it's a little solid.
So, don't be afraid to look at the stocks that you would not think would be doing well, but if they're paying dividends, you got to add that in there.
Yeah, but we're not stockbrokers, and we don't pretend to be, and we don't play one on TV.
And I have no money in the stock market.
Yeah, so take all your advice.
Everything that I have is in real estate.
Yeah,
because I understand it better.
Yes, absolutely.
Okay.
Smart way to go.
Hey guys.
And he made it.
Did you have to wear your water wings?
It took a little over 2 hours to get from Concord to Rock Hill.
Wow, that's insane. That's
Yeah, there was a stretch of 85 that was underwater, and then there was a couple accidents along the way. So
wow,
it was
shocked that people would run into one another with a highway full of water.
Well, I don't understand, when it rains, everybody puts on a stupid hat before they start driving. For some reason, I don't get
here's
it.
Another soapbox of mine. If you're a driver in Rock Hill, you already have your stupid hat on.
Oh, that's not true. We have no traffic in Rock Hill. We're great. I should say that. Other people will move here.
I do have to say, by the way, Scott, Allison made a comment about how impressed she was with our breaking news video.
Yeah. We worked hard on that.
So kudos.
Yeah. Kudos to our guy on that, for sure.
So we hadn't started our questions yet. We just finished up with our breaking news. So, yeah. Scott, it's time for another graphic. It's now time to do. Actually, it's today's ugly question, John.
Yeah.
So, why does it matter if a fund has debt rather than equity?
I don't know.
All right, if you're a fund investor,
Well, first of
A
all,
lot of
talk about the
times-
difference between debt and equity. Okay. See, I'll tell him how to
Thank
answer.
you.
I won't tell him what to say.
If you look at a fund, sometimes they're only debt and sometimes they're only equity. What's the difference? Well, debt means you're lending the fund money and you get a particular guaranteed rate of return because it's like a CD. You're lending the fund money over a period of time. Now, that in some cases, and it depends on the way the thing is set up. If you lent the fund $50,000,
Like me as an investor that wants to invest my money into the fund. That's what you mean?
yes.
Okay.
If you lent the fund $50,000, you may get a lower rate of return than if you lend the fund $100,000. So they may have what's called a capital stack. The person that puts in the most money gets the better rate of return. And then you can also segment that out on a period of time. So if I'm lending the money for 2 years, I may get a lower rate of return than I would if I put my money in for 5 years. Does that make sense?
Mm-hmm.
So go ahead.
When I read that question, I read it a little bit differently.
Well, I'm going to get into that too.
Okay.
Go ahead and
Okay.
finish
Yeah.
your thought, Jonathan.
Well,
Finish your thought.
when you go into a fund, even if it's a debt fund, as a member, you are an equity owner. So, that is the equity piece. But if a fund takes on debt, then that stacks on top of your equity ownership, which creates a greater liability beyond just what the fund owes to you as an equity owner. But that's where I would go with it. I'm sure Bill was going right there too.
Well, and then so let's talk about the equity side of things. So what you're doing on an equity side is that you're not getting anything guaranteed. You're getting a piece of the profit that the fund makes. So typically you're going to get a higher rate of return, but it's not going to be guaranteed that rate of return.
And when you do that, you don't always get a pref quarterly or monthly. A lot of times, if you're in the equity piece, you're waiting years before you get any return.
Mm-hmm.
Yeah, and it depends on the fund that you're in. If you're in a fund that essentially is a value add on properties, so the fund is buying, we'll just say a self-storage that is only 45% occupied and needs a lot of work. Well, the fund's job is to buy that at a big discount, to fix it up, get it tenanted up to whatever the market rate is, and then that's going to bring value. So while you may not even get any income along the way until it gets to a certain point, and then it starts paying income. And then your bonus at the end is one of two things. It's either the sale of the property and you get, a percentage of the profit, or it could be refinancing it and getting a certain percentage of what the new value is. And you're getting, if it's a refinance, you're actually in a better position because you're not going to have any capital gains tax to deal with.
Awesome.
Yeah.
Because that money, if a refinance, would be tax free. If they sell it, then you're going to be subject to capital gains. Not to mention, if you're taking depreciation over time, when you sell something at a profit that you've been depreciating, you have to pay that depreciation back. And then once you've paid the depreciation back, then you got to pay the capital gains on what's left over.
Okay, so all this for me is clear as mud. And I'm really wondering what the debt is in a fund. So you've got debt, like when you invest in a fund, you could be lending money to that fund, but there's also another way to look at debt in a fund, and does the fund have debt against it?
Well, that's what Jonathan just covered. So the debt would be, let's say I had 15 million in a fund, but I wanted 30 million of dollars to lend with.
Right.
Well, you could, and I'm, for the sake of this conversation, I'm trying to keep it easy math. So you could find a credit facility, and it's similar to if you got a home equity line of credit.
Right.
Based on the value of your home. In this
Right.
case, you're putting up the $15 million worth of assets that you have in that fund. So if it's a lending fund, for example, we have $15 million worth of loans that are out, and we are holding, deeds of trust or mortgages on those properties.
Mhm.
We're essentially putting up that collateral for the next 15 million.
So who gets paid first?
Hang on. Why would you do that? Well, there's a couple of reasons you would do that. Is that you are probably going to be borrowing the money at, let's say 4 or 5%, and you're paying, 7, 8, 9% to your investors. You're getting the money cheaper.
Mm-hmm.
At the same time, you're going to make more money in volume. Now, the investors are getting an advantage because the money's cheaper. So that means there's more profit.
Right.
Right. So they're still benefiting. The downside to having debt on a fund is that if any of you were around in 2008 and had a home equity line of credit and found one day that they
didn't
cut your line of credit off.
That's right. Oh, we want all our money back, please.
The same thing happens with credit facilities. You have to renew these things, right, Jonathan?
Yeah, and I mean, you even bring it home to right now in the last year, people who leverage their funds, and the people who the facilities that they leverage them with called those lines due because of a global pandemic. Mm-hmm. Well, who does the fund? Who is it obligated to pay first? The line,
right?
Mm-hmm.
Yeah, it's so while there is. There are advantages of leverage fund. One is, I mean, for the investors in the fund, you can make a higher return on the money that you invested in. Absolutely. Right. For the managers of the fund, they can make a higher management fee because they have more assets, money under management. So, both can make more, but the downside, and I think Bill and Wendy and even I, we all share this, same philosophy. The downside outweighs the upside for us and how we choose to run things.
Well, we've been around, and we've been around the block a few times, and we've seen others, and that's one of this is wisdom.
And we have it.
I'm saying that because
we earned it.
I'm saying this is wisdom because we learned it from watching others.
Yeah,
it didn't happen to us.
That's true. That's true.
But you can find yourself as an investor being stuck in a fund that, let's say, worst case scenario, here's the worst case scenario. All of our loans go bad because the market has changed and no one can pay their bills anymore.
Right.
If you have no debt on the fund, that's not awful. It's not great. It's not awful because you can now take those homes, finish them up, and rent them out and get a decent rate of return.
Right.
The problem is if you have debt on your fund and you do that, where does all the money go that you're receiving? It goes to the creditor or the credit facility, not the investors, because they continue to get the income until that line is paid off.
Right.
And the only way you're going to pay that line off is to sell some properties in order to pay it off.
And
if you sell
market,
and if you're selling the properties at a loss to do so, then that's also a detriment to the value of the fund. So that's why we prefer not to carry any debt. We like it organically and to be able to control it because as soon as, and I add this back in with the stock market, but institutional investors, when there are some headwinds, they can pull the rug out from under you. And we would rather be in a position that we um, choose our own destiny.
Right.
Yeah.
Right.
And the thing is, like, is it easier to go out there and leverage your fund and create more assets under management so that, and your investors can make more money and you can as a fund manager? Absolutely. It's way easier to do that than the alternative, which the alternative, hold on, I've got a,
yeah, I'm
something
getting it
going.
too.
Me too.
Yeah,
There's
we got
flood.
some flood warnings here.
We
The
already knew
alternative,
that.
yeah, the alternative to going out and leveraging your fund is to, grow it organically and wait and be patient, or
Solid.
to sell loans and recapitalize that way. And again, Wendy, Bill, and my philosophy is we want to do it slow and right, slow and correctly. So, would we like to make more money? Sure, we would. Everyone would like to make more money,
Yeah,
but we
what
don't want to make more money in the short term for the potential of a big loss to our investors and ourselves.
That's right. We don't want to build our house on sand.
Yep.
We want to build it on rock. We want to make sure that our seeds take root deeply so that when the storms come, we're not getting blown over, right? Well, no, it's biblical. It is. It's absolutely biblical. It is written. That's the way it should work. And
now it's been spoken.
And when we leave, it was spoken a long time before.
And so shall it be.
Yes, that's right. I'm going down that path. That's the one I trust. So it just certainly makes us all feel a lot better when we feel that way. And it's hard when we see other funds that are producing a lot higher return.
Bigger and flashier.
Yeah, and
those managers are out there driving Lamborghinis, and we're over here, putting around in our little Toyota.
That's right. But you know what?
Yeah, as an investor, you should be happy to know that I drive a Volkswagen Passat diesel.
It's nice. His radio is incredible.
Yeah. All the important stuff. I got a good stereo.
The sound system's awesome. But it's just we sleep easily at night, right? And it's all for us. It's all about protecting the investors that trust us.
Yeah.
And we look at everybody as if it's our mother's money.
Because some of it is.
Yeah. And you don't want to make her mad.
So Wendell had a great question. Hey, Wendell.
Yeah.
Hadn't seen you in a while.
I saw you yesterday.
All right. So how or do we calculate tax benefits and principal pay down as part of the rate of return? You do.
Good.
But it's kind of two different questions. One would be oriented in lending money, and then the other one is being an equity member. So the tax benefits, by the way, you're not getting any tax benefits from being on the lending side of a fund investor. If you're lending the fund money, there are no tax benefits, no matter what it is they're investing in.
Mm-hmm.
You're just a lender, and you're going to get ordinary income, and that's how you're going to be treated tax-wise. At the end of every year, it's just considered ordinary income. Mm-hmm. That said, if you do it in a tax-deferred or tax-exempt vehicle, such as an IRA, now you're dealing with some tax benefits, but you're creating them because of the entity that you're lending in. Mm-hmm. It has nothing to do with the fund itself. On the other side of that, with tax benefits, with depreciation and some expenses that can be passed through to the investor, that would be in a fund that is holding property. And the point of the holding the property is to get those tax benefits. And what you use those tax benefits for are not necessarily your W-2 income if you have some on the side. Those tax benefits are only going to help if you have other investment losses. So keep that in mind. And again, I'm not a CPA. I don't play one on TV or none of that stuff. Check with your CPA, but that's the way I've been told it works. But if you're in a fund that holds properties, there are ways of, I was telling you that you'd be subject to capital gains if they sold that property and paid you back. You could always take that money and do a 1031 exchange and get into another fund that's holding properties of like value, and then move that down the road and make your heirs pay the tax. Actually, I laugh about that, but your heirs, when you pass away, they can reset it and they don't have to pay tax on it either.
Yeah, and Wendell has a lot of heirs, let me tell you. He's got like 200 kids.
So I hope that helped there.
I think Mark's question, have you seen, if I have an opportunity zone fund, would you be able to lend to my fund to purchase real estate? Short answer is no. Our fund cannot lend to other funds, but we could lend on the real estate. We could be the debt component to the real estate, and your fund could be the equity component capturing the benefits of investing and buying a property in the opportunity zone.
Yeah, our fund is not set up to do fund-to-fund investing. There are other funds that can do that. Ours just isn't set up. So it's not a rule that says a fund can't do it. Just ours in particular can.
Mm-hmm.
Do we know of any off the top of our head that does fund-to-fund?
Yeah.
Mike Zlotnick,
right?
Yeah. And Tempo
funding.
Actually, the
Tempo
way to find
Capital?
Mike is bigmikefund.com.
Yeah.
It's Tempo Growth Fund, I believe is what it's called.
That's
Tempo
right.
Growth Fund.
That's right.
So he has Tempo Growth and Tempo Opportunity. I don't know which fund does what, but the best way to find him is bigmikefund.com.
Yeah, there it is. Scott just put it in there, Tempo Growth Fund, and we've had him speak on here a
And
couple
we'll have
times.
him
We'll
back.
have him back. Yeah.
Yep.
Mike is
like the smartest guy in the world. He's a big old giant Russian guy that
he's
is gentle as a bear.
He's a mathematician by trade and was in software, but his real passion was in real estate.
Yeah.
So he picked the right venue.
No doubt. He's great at it.
So I hope that helps with the equity versus the lending. Essentially, you're going to lend a fund money, or you're going to be a part of the group of ownership, which is going to be, their return is going to be based off the profit each quarter, not a rate of return that's guaranteed if you're a lender.
And that's one of the questions that you should ask before you get into any fund when you're talking to a fund manager. Is your fund leveraged, or do you plan to leverage your fund?
Yeah.
I will tell you that our
Jonathan.
documents allow us to do so, because as a manager, you want to leave all your options open. But I can tell you, we've never done it, and we don't intend to do it because we don't believe in it. But frankly, when we started the fund, our documents were kind of a template, and we were following the wisdom of the
Fairway America. Oh yeah, there. Okay, so there's Mike's website that you can go to if you want to give him a shout for seeing if he can invest in your fund.
Yeah, if you have a good property that you're doing, he's very interested in, and it depends on what market you're in as well. I'm assuming he's not doing a lot in New York right now.
And tell him you know us. He's really picky about who he deals with. So
in that case,
that
don't
probably
tell him.
Won't hurt you.
In that case, don't tell him you know us. But yeah, Jonathan's correct. You should always be one of the questions when you're looking at investing in a fund. Are you leveraged, and how much leverage do you have if you are?
Yeah, is it 1-to-1, 2-to-1? I mean, there were some out there. I'm sure they're not around now. They were 10 and 15-to-1. I mean, that's.
Tell me what you mean by that. 1-to-1, 2-to-1, 10.
So
10.
for every dollar the fund had, it was borrowing $10 if it's 10-to-1.
Ouch.
So
that's like margin calls if you're in stock. That's like when you buy a house and you put no money down, you're over leveraged if the values drop.
Yeah. 1-to-1, 2-to-1's not bad, but I mean, when you start getting 3, 4, 5, up that way, I mean, it's for me, it gets a little scary. I probably couldn't sleep at night with that.
Yeah.
And frankly, the credit facility is not very intelligent if they're loaning that much. Because let's think about it. What collateral are they going to use if they, if the fund manager goes under?
Mm-hmm. Yep.
Yeah. Yeah. There's nothing there. There's absolutely nothing there. And I think another good question to ask, I know, that's not really what this topic is, but you brought up that question. You need to ask that question about leverage. Another good question to really understand is, what is that fund doing as a fund? We don't lend fund to fund. And we do that. Why did we not do that? Do you recall why we decided not to go in that direction?
Because if you lend, all right, at the end of every,
you can't control what the other fund's doing, right?
That's right. You lose control. Now, the first thing I tell people that are asking whether it's a good idea or a good fit for them to get into a fund, the first thing I ask them is, are you a control freak?
Yeah.
Because if you are, you don't want to be in a fund.
That's
because
right.
you have no control.
Right.
The manager has all the control.
Which means you need to trust them.
So as a manager, I have all the control.
Mm-hmm.
I don't want to put money into something that I have no control over.
That's right.
So here's what it boils down to is, if I have a certain part of the investment in another fund, and that fund takes an extra 2 months to get W-2s, K-1s, tax documents, you're having to wait on them.
Right.
And then you as investors are jumping all over us because you don't have the documents you need at the end of the year, or you haven't been able to close your books out because you're waiting on somebody else. That's why we're not doing it.
Or that fund might have leverage against it.
Yeah.
You never know. But understanding what that fund does to create its return, I think any fund that you're investing in
now
is really important.
And there's nothing wrong with fund to fund investing as
Right.
long as you, as a fund manager, done your due diligence and you're doing business with, knowledgeable and upstanding folks.
Yeah, and Mike Zlotnick is definitely one that we trust completely and know that
and
he's
his
really
his
particular.
fund does fund to fund investing, and they invest in stuff that Fairway America does.
Yeah,
and they're very experienced folks too. It's just as a smaller fund, I want to make sure that it's my fault if stuff doesn't get done,
right?
Not somebody else's.
I'll blame you.
I want to be where the buck stops. Okay.
Yeah, for sure.
I think we've beaten that dead horse, haven't we?
We got another question we can ask.
All right, this is going to be related more to the.
Hey, Marshall.
Hey, Marshall. To the borrowing side of things. Go ahead.
Do we get another video to go along with this?
No, we're already doing that.
Okay, so this question.
Smart ass.
Thank you, Scott. I needed that. So this one is, how does a bankruptcy, foreclosure, or forbearance affect my ability to qualify for a hard money loan? We're not talking about conventional. We're just talking about hard money loans. How does that affect? Depends really on what type of lender the hard money lender is.
Well, let's start with the first one. Bankruptcy. If you're looking at a bankruptcy, what do you do? If you're reviewing a borrower.
Okay, so I'm not an asset-based lender. I'm a lender that I care about the asset, but I also care about the borrower's ability to pay it back. That's who we are.
So someone who's
you probably can't see it behind me right here, but the 5 C's of credit are right behind me on the board. Number one is character.
Yeah. Character is definitely one of them. So bankruptcy is it depends. I can tell you we don't like it, just like any bank wouldn't like it. We want to know the circumstances. We want to know how far back in your life this occurred. So we're going to get pretty tight about it. But somebody who's an asset-based lender may not care at all, right?
Mm-hmm. Yeah.
So,
Yeah.
Jonathan, what's your thought on? I just got another alert from the storm.
Well, it's for me. It's the circumstances. What happened? What did the borrower? What did they do? And when was it? So if they're a contractor and they have bankruptcy from 2008, 9, 10, what contractor doesn't? So that
Was it a 7, 11, 13,
yeah, like if I see that, like that doesn't bother me. That doesn't give me much pause. Now, if I see a bankruptcy, inside of 5 years, then okay, I'm probably bringing in some more questions, like what happened, what was going on, and there are like Wendy said, some lenders are completely asset based. Like they don't, as long as they hit their LTV, they're fine. They don't really care. There's others who do care, but there are still ways around that. I mean, if there's a bankruptcy that's new enough where it causes pause, we can create, or you as the borrower would create a new entity only for that asset, and it would be an asset like a bankruptcy remote entity. And that would be one way to kind of work around that. If we thought that there was a higher risk of a bankruptcy, we probably wouldn't do it. But to make us feel warm and fuzzy and able to sleep at night, we might throw that into a bankruptcy remote entity so that we can not worry so much about that.
Right. Same thing with let's hit the foreclosure part. We don't like foreclosures, do we?
Oh, because those are things we have to do occasionally.
Foreclosures are tough. I mean, in fact, in some cases, a foreclosure makes me feel a little more queasy than even a bankruptcy does. How are you feeling about that, Jonathan?
Yeah, again, it comes down to what happened. I mean, if you got a loan from an asset-based lender who wanted your asset and they just foreclosed on you, okay, I can understand that. Now, if you got a loan from a bank, a conventional institution, or a lender who doesn't want the property back and they still had to take it back, that's an issue. I don't like that.
Yeah, no matter how far back it was, right?
Yeah. I mean, there's so many options that don't end in foreclosure. Like, did your property not have enough equity? Did you not know what you were doing? Did you not do what you were supposed to do? Why didn't you do what you were supposed to do? The lender didn't want the property and tried to, we talked about this before, like we drag borrowers to the finish line. Like we do not want properties. So if there was a lender who was dragging you and still couldn't get to the finish line, that's an issue. I mean, we've had our share of borrowers that we tried to drag to the finish line and couldn't get them there. I mean, and would we lend to them again? No, absolutely not. So,
and they've asked.
Yeah, and they've asked. No, we're not going to do that.
That's for sure. I do know though I know a couple of people from back in 2008 that had like 30 properties foreclosed on. And they're people that I know that are good, solid folks that did everything they could to get, their debt paid back as much as they could. But when you're inundated with that many properties, it's kind of hard to overcome. So, we certainly would want to see. So what's happened between then and now?
Yep.
What have you done differently? How much money do you have in the bank? That's a big question, right?
Yeah. Yeah. I mean, foreclosures, no one likes them. No one likes to see them, but there's always a story. And, like I just said, character is top of our list. What did you do? Like what you did as the borrower? And, that story tells us a lot about what we can expect in the future. Because like it or not, the only indicator of future behavior is past. That's all we got.
That's exactly right. We've had, we've had people that, of course, we foreclosed on that came along with us every step of the way, that never went dark, responded to all our phone calls, that called us in advance before anything negative was even beginning to happen, that asked us for advice, and those people we're very grateful for. And then we've had the complete opposite. So we've only got like 10 minutes left, Jonathan. And I think the most important word we're talking about here in this sentence is forbearance. Talk a little bit about forbearance and what that really means and why it should be scary for people to go into forbearance.
Well, on the conventional side, it should be very scary, especially if you don't need it. Right. Which, that's a whole nother, conversation probably for another time. But, on the conventional side, forbearance just means the lender is forbearing from pursuing default remedies, which just means foreclosure or, whatever other remedies that's in the note in the security instrument. And they're forbearing to do so because of certain reasons. Maybe it was, maybe COVID-19. Maybe you've experienced a financial hardship. You've just lost your job, whatever it may be. The lender is choosing to forbear. Now, on the conventional side, when they do that, it's not choosing to forbear without being repaid, or choosing to forbear with pushing out your term. Instead of it being, a 30-year term and you get a 3-month forbearance, it's not a 30-year and 3-month term now. You have to pay those months back on the 4th. So when the 4th month comes, you don't owe 1 payment, you owe 4. So that's an issue, and that can really hurt people. Now, if you're getting a forbearance from your hard money lender, private lender, whatever it may be, there's probably a little more wiggle room. Flexibility might be a better word. Flexibility on how that's structured. I know we've done a couple forbearances because of COVID-19. I know we did one on a movie theater that we have, and we, instead of being like the conventional lender where, hey, we'll give you 3 months, no payments, and on the 4th, you owe us all those payments. I think we understand that, like, we'll take the movie theater, for example. It's a income producing asset, and it's only income producing if people are going to it. Well, in North Carolina, there was a moratorium on going, the governor banned people going to movie theaters, which was weird because, and I get that at the beginning, but, there was like bowling alleys open, but not movie theaters, which I don't understand. But, yeah. Anyway, but instead of saying, hey, on the 4th month you owe us all this, what we did was we just pushed that to the maturity, and we can do that because we are short-term lenders. Because the maturity is only 4 or 6 months away, not 30 years away. So,
well,
go ahead.
The other reason too is your conventional loans, for the most part, are sold, they're securitized and then sold on Wall Street.
Yep.
And then what happens if you modify the loan instead of forbearing? Then you have to take it out of that securities pool, which is a real pain in the butt. The lender has to take it back. They have to,
and by take it back, buy it back is what.
They have to buy the thing back. They have to get it caught back up again and then re-securitize it. But now you're securitizing a loan that was not paying on time. You're re-securitizing a loan that has been, what do they call that?
So now it's got
reperforming.
Yeah.
It's reperforming, which means it wasn't performing at one time, and now they have to sell it back at a lower price.
Because it's dented and scratched, just like your washer and dryer.
Yeah, that's there's a whole industry built around that, buying scratch and dent loan, getting them reperforming, modified, and then reselling. I mean, we can get
So
into the numbers, but it's fun
why
stuff.
why the bank can't just do this. This is
Yeah.
why they don't own the loan anymore.
Yeah.
Mhm.
They may be servicing it, but it's not their loan anymore.
Yeah.
Yep. Yeah.
Well,
So, but
all right.
yeah, that's I think if I think we've maybe mentioned this before about the forbearances, but if I could warn anyone on the conventional side, like if you don't need a forbearance,
yeah.
and don't believe everything you see on TV. If you personally don't need it, don't get it. It's not worth it. I don't know the numbers in front of me, and we'll know probably in the next few months. I wonder, though, what those numbers are of how many distressed loans there are that were caused by forbearances that didn't need to happen.
Right.
Right.
Right. And didn't understand that when it was over, you got to step up to the plate and pay the whole kit and caboodle. Or some of them will give you a certain time period to pay it. Like over the 3 months that we come back, you need to have it caught up, or however they're going to set it up. But it's,
it's still like logically, it doesn't even make sense to me. It's like, I don't have the ability to pay 3 months. Okay, good. Don't pay that. But on the 4th month, you owe 4 payments. Well, if I don't have the ability to pay 3 months, how am I going to pay it all on the 4th?
That's exactly right.
Yeah, if you go on unemployment for 3 months and then you come back to work, you're not getting a 3 months bonus when you come back to work.
Yeah, normally.
So
that's not what happens.
Anyway, that forbearance thing is nuts.
Yeah.
But right, if you have a forbearance and on a hard money loan, I mean, one of the things that we look at when we're because if we're talking forbearance, if we're looking at the loan, we're talking about a refinance. That we would be refinancing. We don't like to see it. I mean, if you are struggling to pay your obligations, unless somehow you got sucked into a 20% interest only loan, which then I would question your intelligence. But
remember, it matter.
Hey, well, if you start getting over 20, I think it starts to matter a little bit. Somewhere between 4 and 12, it's probably not for me, it doesn't really matter so much, but especially on value add stuff. But we've already had that discussion. But yeah, if you're already struggling to pay, that's an issue. I mean, if you can't, again, the only way you're probably going to refinance if you're struggling is with an asset-based lender who doesn't care about your performance because they're hoping you fail.
Yeah, that's
and
right.
By the way, they're not going to lend you very much money because they need to have a really good cushion.
Yeah, they want that. They want a strong equity.
They want a good deal on that property.
We're
all right. So this is unusual. I'm going to have to tell Jonathan to stop talking.
I was trapped in a car for so long. I was like, I just can't talk
now. Thanks everybody for joining us. Again, the show is called Passive Income Active Wealth. Mm-hmm. We are a lender. We are not an asset-based only lender. We are a hard money lender, but we
want it paid back.
Yeah, that's right. So if you're a borrower interested in borrowing money, carolinahardmoney.com, click on the Apply Now tab. If you are an investor and you're looking for long-term passive gains, click on the Investor tab. Don't forget to share, like, subscribe, hit the bell, all that good stuff. Have a wonderful day. We'll see you soon.
Stay dry.